How's it going, everybody? Welcome back to the Crunch and Numbers YouTube channel. In today's video, we'll be going over subsequent events and how exactly it relates to accounting. So whether you're studying for the FAR CPA exam or you're within an intermediate accounting class, then this is definitely the video for you. Now within this video, I'll be giving a quick overview of what exactly subsequent events are, when to use subsequent events, the different types of subsequent events, and different evaluation periods of subsequent events. However, if you want to skip right to the examples that we go over later on in this video, I'll leave timestamps below for you. That being said, let's get right into it. So what exactly are subsequent events? Well, subsequent event is an event or transaction that occurs after a company's balance sheet date, but before the financial statements are issued or available to be issued. Now, there's different types of subsequent events, two in particular, the recognized subsequent event and a non-recognized subsequent event. So, recognized subsequent event is just an event that affects a condition that existed as of or before the balance sheet date. In these cases, you would record an accrual and make a disclosure. And on the contrary, there's a non-recognized subsequent event. So in these cases, these are events that just affect conditions that did not exist as of the balance sheet date. And you would provide a disclosure only in this case. Next, focusing on different evaluation periods, there's two in particular, issued and available to be issued. In the case of issued, this applies to public companies only, and it's when financial statements must be widely distributed to financial statement users and is in a form that complies with GAAP. And on the other hand, there's available to be issued. Now, this is used when it applies to private companies only, and this is when financial statements are in a form that complies with GAAP and has received necessary approvals for issuance. So they don't necessarily need to be widely distributed just yet, just receive those approvals. Now, really quick, when it comes to reissued or revised financial statements, just keep in mind we're never going to recognize or disclose events that have occurred from the issued or available to be issued date through the reissued or, say, revised date for financial statements. That being said, let's jump into our first round of examples here. So, example 1, the problem. Skull Company is a public company that has a balance sheet date of December 31st, year 1. Company's financial statements are to be issued on February 17th, year 2. The following events took place after the balance sheet date. Now, what we're going to want to do here is either say whether the company should provide an accrual and disclosure, a disclosure only, or say none of the above. So within the problem, first you just want to take a look when the balance sheet date is, which it gives us a balance sheet date of December 31st, year 1. It's the first thing you should be looking for. Next, since it's a public company and they issued the financial statements issued on February 17th, year 2. Remember, we're going to use the issue date when it comes to public companies, available to be issued when it comes to private companies. So taking a look at the first one here, Skull Company made arrangements to purchase Pumpkin Company for $750,000. These arrangements resulted in a purchase date which occurred on January 3rd, year 2. Well, the purchase date occurred on January 3rd, year 2, which affects a condition that did not exist as of the balance sheet date, since January 3rd, year 2 is after the balance sheet date of December 31st, year 1. In turn, that would be a non-recognized subsequent event. Therefore, you would provide a disclosure only. So D for disclosure. Moving on to the next one here, Skull Company was found guilty in a lawsuit that was originally filed in year 1. Okay, so originally filed year 1. The guilty verdict came on February 9th, year 2, which required Skull to pay $50,000. Okay, so this guilty verdict came on February 9th, year 2, which happened after the balance sheet date. However, it affects a condition that existed as of the balance sheet date because the original lawsuit was filed in year 1. Therefore, that would be a recognized subsequent event. In that case, we would provide or record an accrual and provide a disclosure. So A for accrual, D for disclosure. For the last one here, Skull Company had aged invoices from Candy Company during year 1. So an event that took place during year 1. Candy Company filed for bankruptcy on February 18th, year 2, which comes after the balance sheet date. However, you have to take a look here. February 18th, year 2 is after the date in which the financial statements are issued, because they're issued on February 17th, year 2. Therefore, we would not make an accrual nor provide a disclosure, since this subsequent event came after the financial statements were issued here. So we would just write none. And if we take a look at our first example 1 solution slide here, number 1, again, you would just provide a disclosure. Number 2, you would record an accrual and provide a disclosure. And number 3, you would do none of the above. Taking a look at our second example here, the problem, Spider Company is a private company and has a balance sheet date of June 30th, year 1. So right off the bat, we should note our balance sheet date, June 30th, year 1. Now in this case, the company's financial statements are to be issued on August 22nd, year 1. Okay, so issued August 22nd, year 1. However, you have to note we're working with a private company here. So we know we recognize subsequent events through the date they're available to be issued. And if we read the next line here, as of August 5th, year 1, Spider Company's financial statements have been compiled in a form that complies with GAAP and has received all of the necessary approvals for issuance, i.e. they're available to be issued as of August 15th, year 1. So we know we're using that date. Following events took place after the balance sheet date. Starting with number 1 here, in a lawsuit filed on July 5th, year 1 by Ghost Company, Spider Company was found guilty and was required to pay out $25,000 on August 1st, year 1. So if we take a look here, this event took place on July 5th, year 1, which is after the balance sheet date, the initial event, and they were found guilty and had to pay $25,000 on August 1st, year 1, which of course is also after the balance sheet date, however, before the financial statements are available to be issued. Therefore, we would provide a disclosure only. Number 2 here, Spider Company was part of another lawsuit originally filed on January 20th, year 1 by which company? So January 20th, year 1, an event that existed as of the balance sheet date. A guilty verdict came on August 15th, year 1, requiring Spider Company to pay $100,000. So this guilty verdict requiring Spider to pay came after the balance sheet date. However, it also came after the date in which Spider Company's financial statements are available to be issued, August 15th. See, they're available to be issued here on August 5th. Therefore, we would provide no accrual and provide no disclosure. Number 3 here, Spider Company had a significant number of age invoices from a particular customer as of the balance sheet date. On July 10th, year 1, that particular customer went bankrupt. So in this case, they had a significant number of aged invoices that existed as of the balance sheet date, and then on July 10th, a subsequent event took place, which is before the financial statements are available to be issued. Therefore, we would record an accrual and provide a disclosure. And if we take a look at our example 2 solution slide here, have number 1, provide disclosure, 2, no transaction whatsoever, 3, record an accrual and provide a disclosure. And that pretty much wraps up everything surrounding subsequent events. A very, very easy topic to go over and understand. However, you can really pick up some crucial points, say in your exams or your homework assignments, by understanding this subsequent event of accounting. That being said, let's go over the question of the video. If in example 2, the balance sheet date was July 6, year 1, how would Spider Company classify the first subsequent event? Remember, leave your answers in the comment section below. The first one I see that's correct, I'll pin at the top. Also, leave in the comment section below what videos you would like to see me make in the future and other topics you would like me to go over. With that being said, I hope you enjoyed this video, and I hope everyone has a good one.